thing going. Get through the chapter 1 discussion here a little bit, and then also maybe get started on chapter 2. Before I do that, let's look at a calendar, because we were talking about it here. So your calendar, your guys' should look much the same as this. Your chapter 1 quiz is due today, right? 11:30 p.m. So try to get that done. Don't try, get it done. Okay. Again, it's open book. You should be able to get through that without too many problems. I think about 6 people had turned it in. Last I looked, they had done okay. Not as well as I would have thought, given that it's kind of an open book thing. And what is there, 25 questions? Who's done it? Something like that. So.
It wasn't too bad.
Yeah. Okay, Wednesday, your chapter 2 quiz is due. Okay, that's, I think, Wednesday night as well. Hopefully I'll get through all the chapter 2 stuff. But then next week's busy because on Friday, your chapter 3 quiz and problems are due. So you might want to plan ahead. You might even want to think ahead. Even though I may not get all the way through chapter 2, I won't today. If you want to jump ahead and take the quiz, you're probably not going to hurt yourself too bad. Open the book and whatnot. And, by chapter 3, like I said, that's going to be more of we'll flip the class, kind of when that hits, right? Quiz stuff you should be able to get out of the book anyhow. Problems is what we'll work on in class. So hopefully I can leave you some time even on Wednesday, but for sure on Friday, okay, to work on those problems. Hopefully you've worked ahead, and then if you got some questions, those are the ones that you bring to class that we can get you guys settled on and get you through them and whatnot. So, okay. So let's rock on or take off or do whatever. Slideshow. Oh, crapes, we were way down on 28, I think. Yep. Agency theory, we won't talk a lot about that. We talk about that in business law. You guys should have talked about that in business law, but it examines the relationship between the owners, managers of the firm. It gets to be a little bit interesting sometimes when you have these big C corporations, and you also have large, what they call institutional investors. That's what's up here. Anybody know what an institutional investor might be? Okay, the world of finance, investment, personal finance for us has really opened up, and we've got lots of ways that we can invest money, including mutual funds, exchange-traded funds, and different things like that. You also have some huge, one of the biggest institutional investors in the country is called CalPERS, which is the California Public Employees Retirement System, right? So people pay, or not companies, but the government, California government pays into that for the employees, and they have their retirement, it's in there, and CalPERS invests that then, right? Okay, they don't just sit at the bank and earn 0.025 or whatever the bank's paying for savings accounts right now. They invest it. They put it into companies like you and I could. And they're an institutional investor, right? Okay, because they've got this huge accumulation of money that they've gotten from all kinds of people, and they're investing it, and so they can have a big influence a lot of times on what these companies do. Other big institutional investors include companies like Vanguard. Vanguard's probably, if not the biggest, second biggest mutual fund company in the nation. They get you to invest in a lot of low-cost index funds, they're called. So you invest your money with them. Yeah, they take a little fee out, but they're one of the lowest. I think they are the lowest cost in the industry, right? But that means that there could be, I think they manage over $1 trillion in money total. And that's divided between a lot of different funds and whatnot, but certainly they're a huge institutional investor. Other companies that you've heard of would be Charles Schwab, T. Rowe Price, Fidelity. Different companies like that they all have mutual funds and ETFs. I think later in the class, probably towards the end, we talk a little bit about mutual funds and ETFs, so I won't spend a ton of time on that. Sarbanes-Oxley came out of the Enron kind of scandal that was in 2005, somewhere around there, 2004, 2000. Yeah, somewhere in that neighborhood. It was kind of interesting. It was the way it happened. That was where a company got a little bit crazy trading. We talked about options and derivatives and those types of things. And the company Enron had been a gas company producing natural gas and selling it and shipping it and doing all that. Well, they kind of changed their MO and they became a company that just traded a lot of gas futures and those types of things. And they primarily quit doing what they had been doing and they got into this trading thing. Well, they started to kind of lose money, and then they started doing some creative bookkeeping is what it amounted to, and the whole thing felt like a house of cards finally. And it cost, I don't know, they had like 30,000 employees that lost retirement accounts, and investors lost everything, you know, that they had in it. The CEO, Ken Lay, he was prosecuted. He was found guilty of fraud, and he was going to be sent to prison, and he saved us all a lot of trouble, and he died before he got to prison, so we didn't have to keep him on the payroll, I guess you'd say, for his extended life. Anyhow, Sarbanes-Oxley kind of came out of that, and it created more controls and whatnot. And the whole idea is that we as investors should get accurate information. Okay, we should be able to get accurate information, and of course the internet has made that, you know, all the more easy for us to be able to get online and get that kind of stuff. So they got to present these things. Again, sometimes that gets a little bit confusing when you get to what they report to the SEC and what they report to the IRS. Sometimes can be two different things, and that can be a little bit weird to look at times. So, goals of financial management, of course, primary goal is to maximize profit. We want to maximize shareholder value, absolutely. Okay. But we take on more risk sometimes when we do that. That can be a little bit scary. So, you know, when they say maximize profit, how about balance? Balance profit and risk would probably be a better term, maybe. Broader goal here, maximizing shareholder wealth. Now, I don't know, you guys follow the news at all? CEOs of 180 companies or something just got together and they just put out this joint statement that the goal of major corporations no longer is to maximize shareholder wealth. It's going to include a bunch of other crap like social responsibility types of things. And this was a link to the article. I won't click on it. One of the articles, there's many of them out there. You can go read it. And it's interesting. I read it and I immediately went back. In fact, I got a copy of it sitting right in my office to an essay that Milton Friedman wrote in 2000, the early 2000s. I think he died in 2007, but he wrote it in the early 2000s. And he said this. He said, that's the only goal of a corporation. That's what they're here for, is to make money. They will serve the public's interests if they make money. Okay? They will. They'll create jobs. They'll do all kinds of things if they make money. And he could defend that very well. You guys probably don't know a lot about Milton Friedman, but he was very eloquent. Who, after he passed away, somebody said everybody loved to argue against Milton Friedman unless he was in the room, you know, because he could argue pretty well with anybody. But anyhow, CEO said that the goals no longer are maximizing shareholder wealth. We've got all this other stuff there. I think there's 7 CEOs that didn't sign on to that or something. So, but that's 180 out of the thousands of major corporations that we have in the U.S. So it's not by any means everybody's philosophy from this time forward. So, yeah. Management, stockholder wealth. Stock options are interesting. Stock options are really interesting. Okay, they're oftentimes offered as compensation to usually to executives, but some companies, especially a lot of modern companies and tech companies, have extended these even to people that are on the lower end of the totem pole, maybe. What that does is it gives you a right to purchase a stock at a strike price, okay? And you have a right to purchase that stock maybe any time up to, let's say in the next 5 years. It might be 10 years, okay? I think 10 years is about as long as they go. It's usually 5 or 10 years. A lot of companies like this because it aligns the goals of the individual with the goals of the corporation, right? The only way you're going to make money on that stock option is if the stock price increases in the next 5 or 10 years. So what do I say you can buy it? Let's say pick a company, XYZ company, and their stock's selling for $10 a share today, and you get a stock option. I'll give Luke 100 options, right? An option to buy 100 shares, I should say, okay, at $10. Well, if he wanted to, he could exercise that option, and he could spend it'd be $1,000 then, right, and buy those 100 shares at $10 a share, okay. But he just wants to sit on them. Because right now the price is $10, right? So 5 years from now, what happens? The price goes up to $15. Does he want to exercise that option? Yeah. He still has to buy those shares. Okay. Now he could probably go to any bank and say, well, I got an option. Okay, it's worth $1,500. I need to borrow $1,000, right? He borrows the $1,000, buys maybe he's got the $1,000, but even if he had to borrow it, he borrows it, he buys the stock. He can turn around and sell it the same day and make the $500 profit, right?
So you don't have to spend the money, but you're locked in. It's kind of like contracted, but you don't have to.
Yeah. You've got no exposure. You've got no downside.
Okay.
As the employee, yeah, in this case, it's like a futures contract or something, but you got no downside. Yeah. Yeah, and they're pretty popular. Okay, when we get looking in Project 2 and we look at the shares outstanding and whatnot for some companies, and again, if we get some time today at the end, I'll look at some companies. But you'll see shares, you'll see earnings per share, and then you'll see a line underneath that that'll say diluted earnings per share. Well, the earnings per share is the number based on the shares that are actually outstanding. But they do a calculation with the diluted earnings per share, and it takes into consideration those options that are outstanding as well, right? Because those employees might well exercise those options, and that would dilute the earnings, right? 2 more shares, and so you would always expect the diluted earnings per share to be a little less than the regular earnings per share. Okay, and you'll see that when we look at some of our deals. Usually, it's not a huge thing. You know, a company like Microsoft has 1 billion shares outstanding or something like that. You know, if they grant options of 100,000 shares to employees, it's hardly even going to show up on their on their report, right? So, but it's an amazing tool that a lot of companies use. So,
Do you see that more in like the publicly traded companies? Or do
probably. Probably. And the reason for that is the liquidity. Okay? You know, if you had stock options at Independence Bank and they offered that and it came time to exercise your options, you wouldn't have a guarantee that somebody would be there to buy it because it's not publicly traded, right? Okay? Whereas if you're working for Microsoft and you get a stock option, you can call your broker the same day and it'll be gone just like that, right? So that's not to say it can't be done. It sure can.
Sure.
Okay?
Yeah.
But it just changes the equation a little bit. So, valuation approach. I was kind of looking at this early, and I don't know that it matters a heck of a lot to our discussion. So, I'm going to skip over it. Basically, it just says the finance managers have to look at all kinds of everything that goes into it, and they got to balance all that and then make decisions, et cetera, et cetera. So, maximize values in the market, attract capital. That can be important both from a equity and a debt, right? As a financial manager, you want to make sure that your company's in a good position, that if you need to borrow money or have an opportunity to, maybe to take advantage of an opportunity, I should say, you want to be in a position where you could do that, right? And maybe do it quickly. You know, if an opportunity came up to buy another bank, okay? You know, when I worked at Independence Bank, we bought 4 other banks, I think, while I was there. Okay, and we had to use a little leverage to do that. Fortunately, we were in a position to do it, right? Okay. Since then, they've added another branch that they added. They just built that one from scratch, basically, in Conrad, actually. So, yeah. Provide employment. You know, that's a big thing, and other benefits to society. When I say that a company's only goal should be to make money, that's true. That doesn't mean that they don't take social responsibility into consideration. They absolutely do, but they do it to the extent that it maximizes their shareholder value, right? So they do get involved in things, whatever it may be, because it may attract customers. It may attract quality employees, you know, that have interests in those types of things that company may be doing. And so there can be lots of reasons to be involved in social responsibility, but what Milton Friedman would say is that those reasons should all lead to the bottom line. Okay? Ultimately, they should lead to the bottom line. So. It talks here about certain cost increasing activities may initially have to be mandatory, and they're talking about government regulations here. Okay, some of these things they gotta make sure that it's regulated so that all companies might have to bear those burdens instead of just a few. Insider trading. Probably the most famous case here was Martha Stewart. You know, and that was an interesting case, long time ago now. You guys probably haven't even heard of Martha Stewart. she was worth $56 million at the time, and her insider trading thing was a couple $100,000. But she was involved in it. She actually never got convicted of insider trading. It's because she wouldn't turn over the documents that would have convicted her probably of insider trading, but she was convicted then of obstruction of justice because she didn't turn over the documents. So, but it was kind of interesting. Nobody can use insider information, right, in order to do short-term profits. Okay. Now, if I'm talking to Luke and Luke, how's the bank doing? And we're having a good conversation about that. We might go and have a few beers, whatever. And if some shares become available and I decide to buy them, say, there's nothing wrong with that. Okay. For one, I'm probably not going to turn around and sell them the next day. I'm going to hold them for a long period of time because that would be my goal as an investor, right? Okay. Now, if I was talking to Luke and Luke said, I still got a few shares, and Luke said, God dang, our quarterly's going to look pretty ugly. We had a crappy quarter. It's really going to be ugly, and stock price might go down. And we get done talking, and I go home and I call up Pete that I know has got an interest in bank stock, and I say, Pete, would you like to buy my bank stock? Okay, and then it goes down when the quarterly report comes out. That's insider trading. Okay, kind of to distinguish between the two. There's nothing wrong. For example, Luke works at the bank. Is there anything wrong with him buying stock in the bank? Hell no. Sorry to keep picking on you, Luke. Nothing wrong with that at all, as long as it's for a long-term thing, right? Okay. Again, if he had inside information that he knew that maybe the bank's earnings were going to be outstanding, okay, and he and Carl had some stock to sell, and Luke bought it, and then sold it 3 days later, when the bank's earnings came out, that might be, okay, a little iffy then. So. You'd want to, could you still go ahead with that transaction? Yeah, as long as Luke told Carl, the earnings are going to be great. I'm not, I'm not going to buffalo you here. I don't want to get accused of anything. Here's what they're going to look like. And Carl says, that's okay. I'd still like to sell my stock, and here's the price. You might want to document something like that, but yeah, just to give you some ideas. So, oops, ethical behavior. Yeah. Warren Buffett said, it takes a lifetime to establish a reputation. I won't have this quote exactly right, but it takes a lifetime to establish a reputation. In 5 minutes, you can lose it, right? And so he says, if you think about that, you'll make your decisions differently. I was kind of like that quote. So, report ethical or unethical behavior. Those, CFOs have to watch for those types of things that are going on and some of the bookkeeping things and whatnot that can happen. Public financial markets might include things like government bonds, right? We can all buy, we can lend money to the government if we choose to, be it the local, state, or federal. And corporate financial markets includes things like equities, stocks that we like to talk about, in corporate bonds. There's domestic and international markets. Somebody asked about that for Project 2. Could we do Adidas, I think came up, or some other, foreign companies. Maybe, but the information's a little tougher to get. Okay, it's a little tougher. They might trade even on our stock exchange, and they have certain reporting requirements also to the SEC. But I've just found I find it's a little more difficult to get information in the same format. You might have a lot of currency things in there too, because you get different currencies that kind of might impact what's going on. And so, I'd probably stay away from those. If you really insisted and we sat down and took a look, we could and make sure that the information's there. Corporate and government markets, we kind of talked about that. The government bonds, also corporate bonds and stocks and equities. Money and capital markets, we'll talk about those here. Money markets, short-term securities, right? Companies will issue short-term bonds. Okay, that's commercial paper, kind of finance those daily things. A lot of smaller companies, I know they go to the bank. They borrow money from the bank and they set it up, and that's where a lot of that commerce takes place. But big companies like to have those access to those types of funds sometimes too, because they may be like a farmer, that has a huge use of funds, need for funds at a certain season, and then that may go away otherwise, so they may have to do some short-term paper here and there, and they have the ability to do that. And then on the other hand, the capital markets deal with longer ones, So you got long-term markets. You'll see corporate bonds out to 30 and 40 years. Government bonds right now are only 30 years. If you watch the news too, you'll hear a lot of folks saying the government ought to issue some 50-year bonds right now. Okay, and why is that? Rates are so stinking low right now. 30-year bonds are at less than 2%. They might be able to do a 50-year bond at 2% in that neighborhood. And if you're the government, why not lock in? If you had a chance to lock in your mortgage for 2% for 50 years, I might even do that, and I like to pay that kind of stuff off early. But God, if I could borrow money at 2%, I'm pretty sure I could invest it and do better than 2%. Okay, Wells Fargo stock's paying 4.5%. Microsoft pays 2% dividend, for crying out loud, and they're AAA rated. They're rated better than the government. So, anyhow, that's long-term maturity or long-term markets. Securities can include common stock. That's the ones that we look at about 99% of the time are the common stocks. Okay, corporate and government bonds, U.S. bonds, also corporates do the same thing. Corporates get out there 30 or 40 years. A lot of them might be borrowing money right now at longer terms just because they can lock in some low rates. Preferred stock you don't see a lot of. Okay, preferred stock you don't see a lot of, and I say. The reason for that is a lot of disadvantages for the company that's issuing preferred stock. Okay, how's that work? The dividends aren't deductible. What are some of the other disadvantages? Now I drew a blank on that one. But and we'll talk about preferred stocks later anyhow, and then hopefully my mind will be working a little bit better. But there's disadvantages to doing it. On the other hand, there's a lot of advantages for the investor, okay? And that's why sometimes companies will issue preferred stock, because they can issue them at lower rates sometimes, because the investors get a little more of an advantage when it comes to that. Preferred stock dividends get paid first. It's kind of why they call it a preferred, over other dividends that might come out for a common shareholder. And so that's why people are oftentimes more willing to invest in preferred stock. Preferred stocks also act more like a bond in a lot of cases. They won't. There are preferred stocks that will go up and down like a common stock, but for the most part, preferred stocks are more like a bond. Okay. The reason that's bad for the company is if they issue debt like a bond, they get to write off the interest, right? But when you pay a preferred dividend, you don't get to write off that dividend expense. So it's kind of an oddball deal. And you don't see a lot of preferred stocks. If you guys look at your companies when you get into Project 2 and whatnot, out of this class, if there's one of those companies that you guys pick that has a preferred stock deal out there, I'd be surprised. Okay, they're not that common. Primary market, that's when a corporation uses financial markets to raise new funds. It's called an IPO, or initial public offering. Anybody think any of those that have happened just recently? I think any of those have happened just recently. I mentioned one, I think, on Monday or Wednesday.
Was there one in the last year or so? Was it Tesla, or who was it?
Tesla's been around for quite a while now, 3, 4, 5 years.
Was it that one in the last year?
There's been several in the last year. Lyft was one. It was about 4, 5, 6 months ago. I think Beyond Meat was just fairly recently. I was just looking at theirs. BYND is their ticker symbol. WeWork, I think, is in the process of possibly going public. Yeah, and I think that's a company kind of like Salesforce.com maybe or something. I'm not that familiar with WeWork, but I've kind of heard of that. Uber is not yet public, okay, but is considering going public, I believe. Okay, I think that's right. I should look that up. But I don't think that Uber is public yet. So, okay, and that's that. Why do companies choose to stay private sometimes, and then why do companies choose to go public? Okay, oftentimes going public is a payoff for the original owners, the original investors. Okay, so Facebook for a long time, it's only been public for 10, 12 years maybe, and for a long time it was just a privately owned company, and there's a lot of reasons that's good. You don't have to report to the SEC. If you're a private company, you don't have to report anything to the SEC. Okay, go to heck. We don't have to do that, right? So you don't have the pressure on you. When you got to report your quarterly numbers, there's a lot of pressure to make those numbers look good. But when you're private, who cares, right? Okay, but when you're Mark Zuckerberg, right, and you've created Facebook, and every bit of your net worth is in Facebook stock, and you can't even afford to go buy a popsicle, because all your money's in Facebook stock, and Facebook stock is private. It may be difficult to sell some of that even. I'm really exaggerating here, don't get me wrong. I'm sure Mark could do that, but maybe he wants to buy a Lamborghini in a mansion, right? So he takes the stock public, and Facebook goes public, and he still retains a whole lot of stock. There's probably no question Zuckerberg probably still controls that, okay, and he still, but he issues the stock, it sells on the market, you and I then can buy it, okay? And guess what? He gets a certain amount. He gets to cash out to a certain extent, right? But he maintains, I'm sure Zuckerberg still has a huge position in that. Some companies, too, when they go public, they'll create B shares or non-voting shares instead of voting shares. So you can purchase stock in a lot of companies where you don't actually have the right to vote. Okay, and that's kind of interesting. Under Armour has a bunch of those, I know. I think Facebook might. I'm not 100% sure about that. No, maybe they don't, because I think they are just FB, so I think that's their only ticker symbol. Okay, but they'll do that because the owner wants to retain control. Usually that'll keep the price of those shares that are non-voting, it'll keep those down a little bit. They'll be a little muted. Okay, because if you're buying stock, you don't like the idea. And if you're an institutional investor, you don't like the idea of, not being given that opportunity to vote. The secondary market's what you and I are probably more familiar with. We're not, let's face it, we're not going to get in probably on an IPO. And why is that? When those companies go public, most of that initial offering of stock is already kind of spoken for. Okay, companies, institutional investors, big ones, they've already stepped up, and they're going to get a certain number of those, right? Okay. And some of them do this right away. They turn right around and sell it right away. If you watch a lot of IPOs, the price kind of jumps right at the start because a lot of people want to get in, and so they're bidding it up a little bit. And so companies that were in early, they'll get their stock out there, and they'll sell some of that, and they can make some money as the stock price goes up right off the bat. But then that becomes the secondary market, right? Then it becomes a secondary market. And that's what we see when you watch the Dow Jones Industrial Average or the S&P or the NASDAQ. Okay, you're seeing the secondary market. They're actually telling you what's going on in that particular market. Okay, and those stocks buy, sell, trade every day, right? Millions and billions of shares probably every day. So again, risk and return, kind of some same stuff there. Restructuring, hopefully we never have to restructure, but that happens. We've seen that in retail, and we're going to see a lot more in retail, right? Restructuring and bankrupt. Poor JCPenney, they've been restructuring for 10 years and haven't made it go. And Sears and Kmart have tried to restructure for the last 10 years, and that's not going to work, right? And so that happens. Got this disruptive technologies that come in their case, it's probably Amazon that's hurting them the worst, but also Walmart and also Target. Target's still doing pretty well. And, Target's not that much different than like a JCPenney was. Why couldn't JCPenney adapt? I don't know. It just makes you wonder. Oh, mergers and acquisitions. Just announced here a couple days ago that Philip Morris and Altria were thinking of merging. So you got your two big tobacco companies, right? And tobacco's kind of going to hell, and the obviously people aren't smoking quite as much anymore. But they said the one reason they might want to merge, I forget which of those companies has a big interest in the vaping. One of the two does, and the other company kind of wanted to get in on that a little bit. And so there was some incentive for them to maybe merge. Internationalization, yep, being able to get money. You know what? Bonds in Germany, you know what they're paying right now? If you wanted to buy a German Bund, or a German bond, a 10-year bond. If you bought a 10-year German bond, any idea what kind of rate? If you think that the rates the bank is paying on your savings account are low, if you buy a 10-year German Bund right now, you get a negative interest rate. Yeah. So if you lend Germany $10,000, what you're saying is that in 10 years, you're going to get back maybe $9,500. Okay? And you won't get anything in between. Okay? Negative rates, that's throughout the developed world right now, actually. Okay, there's a lot of countries that have negative interest rates. One of the reasons the U.S. is attracting capital and maybe doing okay is that actually our rates are considered high, even though our 10 years at 1.5 roughly, and our 30 years about 1.9, something like that. But that's pretty enticing for a lot of folks, right? Because in Germany you don't get squat. You get less than squat. Technology impact on capital, it's, that's just amazing how that's changed. I grew up in the world. Anybody ever watched the movie? It had Eddie Murphy in it. Dan Aykroyd. Trading Places. It's an old-fashioned comedy. You guys have to watch it. Eddie Murphy was kind of funny. But you see him down there on the trading floor, and they're doing the yelling and the screaming, and they're holding up the deals. Yeah, that's when I grew up. That's how they traded stocks, equities. They still do some trading like that, I think, on some of the commodities and whatnot. But that's how they were traded back then, yelling and screaming and holding up tabs. And the guys wore different. They all wore different colored lapels on their suits and whatnot, because that's how they could distinguish what security they were trading in and whatnot. And it was wild and crazy. Okay, and a lot of that's gone away because technology has replaced that, right? Right now, you place an order, maybe you got to go through a brokerage still, be it D.A. Davidson or Raymond James or Edward Jones or White Ellen Reed or whoever it is, and I'm sure that just gets posted electronically. And if there's a post on the, like say you want to buy 100 shares at $10, and somebody over here has 100 shares that they want to sell for $10, the two meet in the middle, and away you go, right? And it gets taken care of. So, and it's all electronic now. In the old days, it was yelling and screaming and hollering, and those guys. It was one of the most stressful, they said, occupations I think in the country back in the day. It may still be, I don't know, but because they're still down there, but now they're just sitting at computer screens. I think just kind of monitoring it and whatnot. That's created these electronic things, yeah. Ooh, there we go, chapter 1. Cool. I got a little time here. I can get started on chapter 2. I'll just take a little time going through that, and then we'll take a look at a couple stocks. Anybody find any companies that they're interested in doing their project 2 on? Has anybody thought about that at all? Nobody yet? Okay, be thinking about that, because in the next week or so, that'll be kind of an ungraded assignment, I think. I don't think I have a grade on that, but just have you guys give that to me, because I just want to check it out, make sure that we're on the same page. That gives me time, because you won't really start working on that until the second half of the semester, but that gives me time to look at all those companies then and make sure that the information's there and that kind of stuff. And if I have any concerns, I can send you back an email or talk to you about it and say, oh, you might want to think about a different company or something. So, okay, nobody's thought about any companies, huh? Man. Basic financial statements. Income statement, right? Income statement is how much money the company made over a period of time. Statement of retained earnings tells you what you keep within the company, so that's after you've paid out dividends, maybe some other things, bought back stock, did some other things, right? The balance sheet is a snapshot of a company's position at any given time. Okay? Those are the things that, if you work at a bank, you look at for every customer. Commercial customer, business customer, or ag customer. Okay, you look at both their income statements and their balance sheets. Statement of cash flows then is also an important thing. Okay. Seeing companies, when I was in banking, you'd see some companies sometimes that would, they'd be showing that they were making a lot of money, but they didn't have any cash flow. You scratch your head, and one that I remember in particular was a dealership. Well, what they were doing was they were giving too much money for trade-ins. Okay, and so they had a whole bunch of used inventory on their lot, right? On the income side, it looked like they were selling stuff, right? And then they had these nice trade-ins that were sitting there, but guess what? The trade-ins, the used inventory wasn't going anyplace, and so they didn't have any cash flow. And you kind of scratch your head and you say, maybe that used stuff isn't as valuable as they thought when they traded it in, and so maybe those profits were a little bit sketchy. And that particular credit we exited, which was good because they went broke a couple of years later. So, income statement, right? Device to measure firm profitability, certain time period. They call it progressive fashion. So you start at the top, and if you listen to the financial news, you'll hear them talk about top line, bottom line. Okay, top line is sales, bottom line is profit. That's it in a nutshell, right? And those are when they report earnings. Those are about the two most important things that investors like to look at. They like to see, well, is their top line growing? We want to see that there's sales growth, and is their bottom line growing? Sometimes one or the other is growing. The top line might be growing, but the bottom line is getting worse. Well, what's happening? Margins are compressing then, right? That's what they would say. That's really in general. You'd have to dig in and get the specifics on that. On the other hand, you could have the top line shrinking and the bottom line growing. Margins are getting better then, okay? So we may not be selling as much, but we're getting more money for everything we're selling, or we've cut expenses drastically, and so we're able to make more money. That happens. Sales first, then you got your cost of goods sold. Okay, and that's the cost of goods sold is calculated in different ways. It kind of depends on the type of company. Manufacturing companies, right? They've got raw materials. They've got the assembly line, whatever types of costs that they might have directly in producing that. Walmart doesn't have that. Right? Walmart's buying from wholesalers, right? Or buying from the manufacturers directly, probably in Walmart's case. So their cost of goods sold is simply what they're writing a check for. Okay, Costco would be the same, right? So it's kind of different in how you do it. Banks are completely different, right? They don't really have a cost of goods sold. They talk about net interest margins. So banks I usually rule out too for Project 2, by the way. Okay, and only because I might let somebody do it that actually works at a bank, because banks themselves, their financial statements are just a little weird. They're not what we typically talk about in class, because their profits, they don't have a cost of goods sold, but they have a net interest margin. They have a interest income, interest expense. Difference in that is net interest margin, and then a lot of the other expenses, personnel and those types of things are similar, but it's just a little different to look at. You got loan loss reserves. Okay, so cost of goods sold sales minus cost of goods sold is gross profit. Gross profit minus expenses is earning before interest and taxes, or EBIT, or operating income is what that's called. Another common one you'll hear, and it's not here on these slides, but I hear it all the time as I watch financial news, is EBITDA. Okay, earnings before interest, taxes, depreciation, and amortization. Okay, that kind of gives you a cash flow number there, a pre-interest cash flow number anyhow, because you're basically adding back in the depreciation and amortization, because those you've heard called non-cash expenses, right? Okay, so that kind of gives you that sort of a cash flow number. Again, you're going to spend money on your interest, but that's another, it's deductible and on and on and on. So EBITDA is a term that I hear pretty often. They talk about that a lot in investings, in the investment world. EBIT minus interest is earnings before taxes. Then you got your taxes, or you take those out, and then you get your net income or profit. Net income and profit basically mean the same thing. There's an example of one. You guys would have that in your textbook as well. Okay, and that's fairly standard. Okay, fairly common. You'll see when you get into bigger corporations, they break a lot of these out though. You'll have different expenses, different things broken out. Okay, some companies might have different types of cost of goods sold, right? Because they got, maybe they're purchasing some inventory over here that they're selling. Maybe they're manufacturing some inventory that they're selling. Hard to say. Or they've got different, Apple sells, they build phones and sell them, and they build iPads and sell them, but what else do they do? Well, they're selling a lot more services now too, right? Like iTunes and those types of things. Amazon has all kinds of sales, retail so they're buying and then reselling. But they also, they've got Prime, right? And people pay a monthly subscription to be a part of Prime. Okay, so that creates kind of a whole, and they, if you really get down into their statements, their financial statements, when you're looking at their annual report, it'll break all of those down. That can get to be a little mind-boggling at times. ROI is a return on investment. It's a little different number. We'll talk more about ROE and ROA, but ROI is as important, or maybe more important, and we talk about that when we get a little later in the chapter. So, and there's nice ways to calculate that. 3 primary sources of capital: bondholders, hit those, right? Common shareholders, those are the 2 most common. Preferred, not all that common. Earnings per share, number that we like to look at, that we like to see. That said, you can't, Apple earns, I don't even know what they earn, $100 per share. No, they don't. Apple earns about $2. No, they earn about $20 per share. Okay, and Microsoft earns $5 per share. Does that mean Apple's worth more than Microsoft? Because it depends on the number of shares outstanding, right? Okay, so the number of shares outstanding has that huge effect. Berkshire Hathaway, their Class A shares earn about $13,000 per year per share, something like that. Anybody know what 1 share of Berkshire A runs for right now?
It's a couple thousand. It's more than that, isn't it?
It's more than that. A little over 300,000 as of today. A little over 300,000 as of today per share. Per share. And all he had out was Berk A. Okay, that was all you could buy up until 1996 or 1998, and then he came out with Berk B. And the only reason he came out with Berk B was because mutual funds were starting to get going pretty good then, and some of these mutual fund companies like Vanguard or whoever it might have been went to Warren and said, look, if you do not issue some shares that a common investor, a normal person, could get into, and back then they were only 10 grand a share. I mean, but still that was a lot of money back then, right? And they said, if you do not do that, we will just create a mutual fund, okay, that owns nothing but Berkshire stocks, so that smaller investors can become invested in your company then. And so he created Berk B, and they sold initially for $1,000 a share. So that means at that time Berk A was selling for about $15,000 a
A
share.
stock is $303,078.
Yeah.
And then
B should be 200 and something.
$203.41.
Yeah. So Berk B came out and it was 1,000. Why is it down to 200 now? When Berkshire bought BNSF, it was kind of a similar thing. So they bought BNSF because Berk B was already up to about $3,000 a share. Okay, it had gone from 1,000 to about 3,000, but he buys BNSF, and a lot of BNSF employees were complaining. They had retirement accounts, and it had BNSF stock, and that was getting redeemed from Berkshire stock. But if they didn't have enough, they were going to get cashed out because 1 share of Berk was worth $3,000, right? So if you only had $2,000 worth of BNSF, you were going to get cashed out, and they were complaining. They were kind of really bitching about that. So they did I think a 50-for-1 stock split, if I'm not mistaken, then on the Berk B. Okay, so it went from 3,000 or 4,000 at the time down to whatever per share, if I remember right.
So they could still retain.
Yeah, a stock split does nothing. It just, you guys did a stock split.
Yeah.
Okay, they went from original 20,000 shares roughly to 200,000 shares. It's 10-for-1 stock split, but each share is worth 1/10 then of what it was worth the day before. So yeah, so it doesn't really change anything other than it makes it a little bit more accessible for a normal investor, right? Because who could buy a $303,000 share or 300 whatever it was?
$303,078.
Yeah, who could buy 1 share of that? Not very many of us. Everybody raise your hand. Okay, yeah, it'd be pretty tough. So, If they asked Warren back in the day, he said he just wanted to keep the riffraff out. He really didn't want. He wanted people that were serious about investing with him to be investing with him, and if you weren't real serious about it, then stay away, kind of. So kind of interesting. But he's changed a little bit. He's getting old. He's 89. Statement of retained earnings, also sometimes called shareholders' equity reconciliation. Similar. Indicates the disposition of the earnings, what you're doing with the earnings. I guess this is different because it is strictly retained earnings. When I talk about a shareholders' equity reconciliation, it throws in some other things too, like buybacks of shares and some of those things, stock options maybe, and some other things like that. So, price to earnings ratio. That's what I was going to look at. Multiplier applied to earnings per. In fact, we'll quit maybe after this, and I'll look at a couple of those companies. Applied to earnings per share to determine current value of common stock, indicates expectations about the future of the company, et cetera, et cetera. Factors that influence PE are obviously the earnings and the price of the stock, but risk and growth. It doesn't say growth on. Yeah, it does. Sales growth. Okay. And what's that mean? Typically, what that means is this: that if you expect a company to grow fast, it should have a higher price to earnings ratio. Okay, it should have a higher price to earnings ratio because you're expecting that company to really kick out some stuff. Companies that are kind of, maybe they're old, they might be perfectly good companies, but they're just kind of old and mature, and they kick out cash, they make money, but they don't have a lot of growth prospects. Okay, you would expect their price to earnings to be lower. A lot of utility companies are that way too. Utility companies are highly regulated, right? So the government's kind of basically telling a lot of like Northwestern Energy, this is how much money you can make, But they're also telling them this is how much money you get to make, right? And so they're pretty stable. Their price to earnings ratio is probably fairly low. Okay. Let's go take a look at a couple. We'll quit there. Remember where I quit. And we'll take a look at another site I like to go to is FINRA. They changed this site, so I had to fight through it a little bit to find the right spot here. But oh, sure, they didn't change it on this one. It took me right to it. Maybe I clicked on the right button or something. But anyhow, if you go just to the FINRA, maybe I'll see if it'll take me to their home page. Yeah, this is what it looks like now. That's a little bit different. So I started here. I had to come over here for investors. So I'd click on that. Tools and calculators. Click on that. Research tools. FINRA market data. Now here I am. I want equities and options. So let's enter a company and figure. I was talking about Beyond Meat earlier. I want to show you that one because I looked theirs up just for the heck of it. Relatively new company. You'll see something a little different with their PE ratio. Minus 833.33. Believe me, that one's kind of out of whack. Why is theirs a negative for one thing? They don't have any earnings. Right? So their price is $167.63. So their numerator is a positive number, but the denominator earnings are negative. Right? So you got one or the other's negative, and the whole thing's negative, right? When you talk about your fractions. So they've got no earnings. Okay? Tesla is probably the same way. In fact, we could take a look at Tesla. TS.
Will Tesla ever get into the positive?
Will they ever?
Yeah.
Yeah, maybe. If what's his name, Elon Musk doesn't just go crazy, more crazy. I don't know. He's one of those. Well, he's a crazy genius.
Oh, yeah,
Yeah, their PE is minus 59, so theirs is the same, right? They got no income. Okay. What would be a fast-growing company maybe that has some income? I don't know if Amazon. Let's go see. AMZN. And no, I don't know the ticker symbol for every single company. I'm just picking companies that I happen to know the ticker symbols for. Yeah, there's 66.67. That's pretty high. The average right now for the S&P, for all the companies that are listed on the S&P 500, that's 500 different companies, is about, I think, 16 or 17, somewhere's in that neighborhood. It changes a little bit every day based on what the market does every day, right? But in that neighborhood, and so Amazon's fairly high. Well, why is that? Amazon still isn't showing a lot of profit. Okay, Bezos is still investing a lot of money back in the company. Okay, and he's purposely doing that. He wants to rule the world. I mean, I really think he maybe does. Okay, and so he's piling money back into there. They're showing a little bit of profit. They didn't show profit at all up until about 3-4 years ago, maybe. Okay, it might even been 2 years ago. Okay, so now they're starting to show a little bit of money, and so they do actually have a PE ratio, 66.67. That's pretty high. Okay, but that's because people expect that. Guess what? That they are going to keep growing. That
So really,
Bezos.
it's kind of just a predictor stat, really.
A little bit. What the
results for it.
yeah, what the investors feel like for those particular companies. Yeah, yeah. By the way, that doesn't have anything to do kind of with your project too. I don't want you to even use the PE ratio, okay? Because you guys are going to be analyzing the underlying financials of the company, okay? When I say that, could you use it when you make your final recommendation? Yeah. But that's it, maybe in the last sentence. But yeah, that's a long ways off. Let me look at just one more real quick. I want to look at Apple. Okay. Because Apple, what's the market cap here? Oh, where's market cap? Market cap. So Amazon's $883.65 billion, so it's just short of $1 trillion in market cap. Apple is 944, so they're kind of similar in size. But look at Apple's PE ratio is only 16, so about the average for the S&P. So people are saying, maybe Apple doesn't have the same growth prospects that an Amazon does. That's just a rough kind of an analysis there that you could give it. Again, there's a lot of underlying financials and those types of things that you want to look at. So, okay, remember, quiz due tonight. Don't forget that one. That's for Chapter 1. Chapter 2, quiz due on Wednesday.
That's 3, right?
Is it at 3, so right after class? Okay. Okay. Let me know if that's wicked. I'll change that if people get behind or whatever. But then you want to get started on Chapter 3 too, because that's going to be due Friday. So, okay, have a good long weekend, right? No class Monday. I won't be here. Holiday.
I got 2. No,
It's 11:30. Chapter 2 quiz.